Which is better, index funds, ETFs, or mutual funds? ETFs trade like stocks throughout the day. Most are passive index trackers, very low fees. Index funds is a type of mutual fund that passively tracks a market index like S&P 500 with low fees. Mutual funds are pooled investments bought and sold at end of day and can be actively or passively managed. The bottom line, for most beginners, broad market index funds or ETFs are excellent choices. The difference between them is minimal. What matters most is the low expense ratios, broad diversification, and consistent, long-term investing. Which specific funds should I pick in my 401k or IRA? Target date funds offer all-in-one solution which automatically adjusts stock or bond mix as you age. It is perfect for set it and forget it investors, but with slightly higher fees than individual index funds, best for beginners who want simplicity. Total market index funds offer the lowest possible fees with maximum control over allocation. It requires manual rebalancing. Common combo, U.S. total stock plus international plus bonds. Best for those who want control and lowest fees. Should I buy individual stocks or just broad index funds? For most beginners, the answer is start with broad index funds. Individual stocks benefits. Higher potential returns. Requires research and monitoring. Single company can go to zero. Most professionals fail to beat the market and emotionally challenging to manage. Broad index funds benefits. Instant diversification. No research required. Virtually impossible to go to zero. Historically outperforms most stock pickers and lower stress and time commitment. Warren Buffett recommends most people invest in low-cost S&P 500 index funds, and he's arguably the greatest stock picker of all time. If you still want individual stocks, consider keeping 90% in index funds and only 5 to 10% in individual stock picks, as fun money you can afford to lose. How risky is the stock market, and how much should I put in stocks versus bonds? Understanding stock market risk. Short term, very volatile. Markets can drop 30 to 50% in a crash. Long term, historically always recovered and grown. The real risk, selling during a downturn or not investing at all. Stock versus bond allocation guidelines. Simple rule of thumb, your age in bonds, rest in stocks. Age 25, 75 to 90% stocks, 10 to 25% bonds. Age 40, 60 to 80% stocks, 20 to 40% bonds. Age 60, 40 to 60% stocks, 40 to 60% bonds. Note, these are guidelines. Your personal risk tolerance, timeline, and goals matter most. Only invest in stocks what you won't need for 5+ years. Money needed sooner should be in safer options. Should I invest a lump sum now or dollar cost average over time? Lump sum investing. Invest all available money at once. Historically produces higher returns. Money is working for you immediately. Psychologically difficult if market drops right after. Dollar cost averaging. Invest fixed amounts on a regular schedule, reduces timing risk and emotional stress, builds investing discipline, slightly lower expected returns statistically. The best strategy is the one you'll actually follow. If lump sum investing will keep you up at night, DCA over 3 to 6 months is perfectly reasonable. How do I avoid losing everything? How to protect yourself? Diversify broadly, own hundreds of companies through index funds, not just a few stocks. Match timeline to risk, don't put short-term money in stocks. Stay invested, don't panic sell during downturns. Avoid speculation, steer clear of meme stocks, crypto gambling, options, etc. Keep an emergency fund, so you're never forced to sell investments at a bad time. What's a reasonable return to expect? Over the long term, the stock market has historically returned about 7% per year after inflation, or roughly 10% before inflation, though individual years can vary widely with gains or losses of 30% or more. Bonds have typically provided lower but steadier returns of around 2–4% annually. Savings accounts offer much lower long-term returns, usually around 1–2%, although current rates are temporarily higher at about 4–5%. How do I decide what money is for retirement versus house versus car versus travel? 4 short-term goals within 0–3 years, such as an emergency fund, vacation, or car purchase, it's best to keep money in high-yield savings accounts, CDs, or money market funds. These options prioritize safety and liquidity with no exposure to stock market risk. For medium-term goals spanning 3 to 10 years, such as a house down payment or major purchase, a conservative approach works best. This may include a mix of bonds and stocks or I-bonds, aiming for modest growth while keeping risk limited. For long-term goals of 10 years or more, such as retirement or financial independence, a more aggressive strategy is appropriate. An allocation of 80 to 100% in stocks maximizes growth potential and takes full advantage of long-term market compounding. Your investment strategy should match each goal's timeline, not your overall risk tolerance. How should I split contributions between 401k, IRA, HSA, and taxable? A smart investing priority starts with contributing to your 401k up to the employer match, since this is essentially free money with an immediate return. Next, if you're eligible, an HSA is often the most powerful account due to its triple tax advantages. After that, consider funding a Roth IRA, which offers tax-free growth for life. Once those are covered, work toward fully maxing out your 401k. Finally, use a taxable brokerage account for investing beyond tax-advantaged limits or for medium-term goals. Don't let perfect be the enemy of good. If this feels overwhelming, just start with step 1 and add more as your income grows.